Hey everyone, welcome back to our channel. Today we're going to dive into a topic that's essential for anyone looking to build wealth over time: investing. If you've been wondering how to start investing, what you need to know, and where to begin, this video is for you. Let's break down the basics and get you on the path to financial success. Why investing matters. First things first, why should you invest your money? Well, simply put, investing is one of the most effective ways to grow your wealth and achieve financial independence. By investing, you're putting your money to work, allowing it to grow over time through the power of compound interest. Whether you're saving for retirement, a down payment on a house, or just looking to build a nest egg, investing can help you reach your financial goals faster. Understand the basics. Before you jump into investing, it's important to understand some basic concepts. Let's start with risk and return. The potential return on an investment usually correlates with the level of risk involved. Higher risk investments, like stocks, offer the possibility of higher returns but come with more volatility. On the other hand, lower risk investments, like bonds, offer more stability but with lower returns. The key is to find a balance that matches your financial goals and risk tolerance. Types of investments. Let's talk about the different types of investments. The most common ones are stocks. When you buy a stock, you're purchasing a share of ownership in a company. Stocks can offer high returns, but they also come with higher risk. Over time, stocks have historically provided strong returns, making them a popular choice for long-term investors. Bonds. Bonds are loans you give to a company or government, and in return, they pay you interest over time. Bonds are generally considered safer than stocks, but they also offer lower returns. They're a good option for balancing risk in your portfolio. Mutual funds and ETFs. Mutual funds and ETFs are collections of stocks or bonds, which allow you to diversify your investments without having to pick individual stocks or bonds. They're managed by professionals, making them a great option for beginners who want exposure to different assets. Real estate. Real estate investing involves purchasing property to generate income or profit from appreciation. It's a tangible asset and can provide steady cash flow, but it also requires more capital and management. How to get started. So you understand the basics, but how do you actually start investing? Here's a step-by-step guide. Set your goals. Start by defining your investment goals. Are you saving for retirement, a major purchase, or just looking to grow your wealth? Knowing your goals will help you choose the right investment strategy. Build an emergency fund. Before you start investing, make sure you have an emergency fund. This should cover 3 to 6 months of living expenses. Investing without an emergency fund can force you to sell your investments at a loss if you need cash quickly. Choose a brokerage account. You'll need a brokerage account to buy and sell investments. There are many online brokerages that offer user-friendly platforms for beginners. Look for one with low fees and educational resources. Start small and diversify. You don't need a lot of money to start investing. Begin with what you can afford and gradually increase your investments as you become more comfortable. Diversifying your investments across different asset classes can help manage risk. Invest regularly. Consistency is key. Set up automatic contributions to your investment accounts to ensure you're investing regularly, regardless of market conditions. This strategy, known as dollar cost averaging, can help smooth out the effects of market volatility. Common mistakes to avoid. Investing can seem intimidating, especially when you're just starting out, but it doesn't have to be if you avoid some of the most common mistakes that beginners often make. Let's go through these in detail so you can navigate your investing journey with confidence. 1. Trying to time the market. It's one of the most tempting yet dangerous strategies, trying to time the market. This involves buying and selling investments based on predictions of future market movements, like when prices will rise or fall. Instead of trying to time the market, focus on long-term growth. Investing should be a marathon, not a sprint. By staying invested over the long term, you're more likely to benefit from the overall upward trend of the market, despite the inevitable ups and downs. 2. Investing without a plan. Another common mistake is jumping into investing without a clear plan. Investing without a plan is like setting sail without a map. You might end up somewhere, but it's unlikely to be where you intended. Before you start, it's essential to define your investment goals. Are you saving for retirement, a down payment on a house, or your child's education? Each goal might require a different approach and time horizon. 3. Putting all your eggs in one basket. Diversification is one of the most important principles in investing. It simply means spreading your investments across different types of assets to reduce risk. Imagine putting all your money into a single stock, and that company faces a downturn. Your entire investment could be at risk. 4. Reacting to market fluctuations. Markets are inherently volatile. They go up, they go down, and sometimes they swing wildly in either direction. One of the biggest mistakes investors make is reacting emotionally to these fluctuations. When the market dips, the instinct might be to sell and cut losses. When it soars, the temptation might be to buy more in fear of missing out. These emotional reactions can lead to poor investment decisions, often resulting in buying high and selling low. The exact opposite of what you want to do. By avoiding these common mistakes, trying to time the market, investing without a plan, putting all your eggs in one basket, and reacting emotionally to market fluctuations, you'll be better positioned for long-term success. Remember, investing is a journey, and by learning from the mistakes of others, you can navigate it more smoothly and with greater confidence. Investing doesn't have to be complicated. Start by educating yourself, set clear goals, and begin with simple, low-cost investments like index funds or ETFs. Over time, you can explore other types of investments as you become more comfortable. Remember, the earlier you start investing, the more time your money has to grow. If you found this video helpful, be sure to hit the like button and subscribe for more tips on financial education. Let us know in the comments what topics you'd like us to cover next.